MD Investor channel, the channel where we're talking about personal finance, setting goals, achieving goals, increasing our financial IQ and that of our children so we can break the cycle of generational poverty. Welcome back to the channel. If it's your first time, welcome back. Consider hitting the subscription button and also consider hitting the notification bell so you'll be notified when new content comes out. Let people and friends know, colleagues, that there's a place to go to where regular people are getting sick and tired of being taken advantage of and they're taking responsibility. Today's video is going to be a continuation of our series, Back to School, lesson on mutual funds. Back to School, lesson on mutual funds. Very common topic, very popular investment tools, but there's something that we want to know about and get ourselves educated. So, what are mutual funds? We did a lesson on stocks, we did a lesson on bonds. What are mutual funds? Mutual funds are basically, in simple terms, investors' money or capital are pooled together, and the mutual fund company goes out and buy basically a whole bunch of companies. All you have to do is buy one share of the mutual fund, and you'll be diversified. Okay, that's in the simplest terms. So we know about buying individual stocks, right? You get a brokerage account and you buy one share of McDonald's. You have one share of McDonald's. But what is the risk with that? Well, the risk with that, the risk with that is that you have one share, you have all your eggs in one basket. Something happened to McDonald's, and the share price drops, or they cut their dividend or whatever. So you are not diversified, and your risk is concentrated in one company. So how do you mitigate that? Well, it would be better if you had 100 companies. But to get 100 different stocks, right? You want to get a share of Home Depot. Then in the old days, you'd have to go and buy and pay a commission, fee. A lot of companies now, a lot of brokerages went away from commission fee, so that's not really an issue anymore. But still, you'd have to buy an entire share, right? You couldn't buy half a share. You have to go buy an entire share of Home Depot, right? And then you have to go buy another share of Pepsi, another share of Coca-Cola, another share of Caterpillar. So you see how it is now. It'd be very expensive for you to buy one share of 100 companies, right? You need a lot of money, right? So mutual fund, that's where mutual fund comes in, right? So some of the pros of mutual fund is that it's convenient, right? The way we just talked about it, that it'd be pretty inconvenient and expensive to go buy one share of all these companies. With a mutual fund, we buy the one share of the mutual fund company, and you are diversified, right? Say the mutual fund goes out and buy Home Depot, Caterpillar, Pepsi, ExxonMobil, all these companies. They go out, and you buy one share of the mutual fund company, and you have a little piece of all of the companies. So you are immediately diversified. It's convenient. It's less expensive than you go now to buy one share of these companies. But what are some of the downside? As you will see, some of the downside of owning a mutual fund, and we're talking about actively managed mutual fund. Some of the downside is the fact that it's actively managed, meaning there's a real person or persons managing these funds. They call them the professional managers. They are actively deciding what stocks to buy, what stock to sell. Like they're managing, and because they're managing it, there is an expense to it. Okay, as you will see later, there's an expense to it, right? The administration, people have to be paid. So that's one of the downsides. So it's professionally managed, and the expense of it is one of the downside of actively managed company. Also, let me add this as well. mutual funds that are actively managed, and there are also mutual funds that are passively managed, such as index fund, which we're not going to get into in this video. Um, but the actively managed mutual funds, which is the one we're going to talk about today, are not really able to beat the market. And when we say the market, we mean like an index fund or like say S&P 500 index fund. They're really not able to beat the market, and you're paying a premium for it, right? So I'm paying a premium, and I'm really not getting better results over the long term. Okay, so we said they're run by a professional fund manager who tries to beat the market, right? Most are unable to do this, right? So they're trying. These are smart people that went to Ivy League school, or they have really deep knowledge. They went to Harvard and Yale and Brown and all this stuff, and they're trying to beat the market. A few years ago, Warren Buffett, the CEO of Berkshire Hathaway, one of the best investors out there, made a $1 million bet with some hedge fund manager, right? Actively managed funds, that over a 10-year span, they would not be able to beat the market, the S&P 500. And he beat them, right? The money went to charity. But basically, it shows that, and Warren Buffett has said this, for the average person, me, you, your brother, your father, your mother, average person who has a regular job and is not spending all their time researching and doing all this stuff, the average person would be served much better by just owning an index fund. Essentially, you're not picking winners and losers. You're just buying the broad market. You're buying the entire market. You have a little of this, you have a little of that. And he said it will be better served. Okay? Um, let's look at an example of a mutual fund. So here it says the best U.S. equity mutual fund as of September 2020. You see here, let's look at the first one. Symbol DFDIX, Delaware Smith Cap Growth Institutional. It's been up 45% since 2020. And you see this expense ratio? This is one of the downside of these actively managed mutual funds. They have elevated or high expense ratio. And expense ratio is basically a percentage that is basically a fee you're going to pay. And the fee you're going to pay is calculated on the sum of your portfolio, right? So expense ratio of 0.85% would mean that you would pay $8.50 for every $1,000 you have invested. Obviously, the more money you have invested, the more money you're going to pay. So expense ratio of 0.85% would mean you'd pay $8.50 for every $1,000 you have invested. So you invest $1,000 into this mutual fund, right? DFDIX. All $1,000 is going to go into it and get invested? No, not all $1,000. It's going to be $1,000 minus $8.50. So that would be about $91.50 would be $991.50 would be invested. The other $8.50 would go to managing the fund fees, and so on. Let's look at what's into it, because I said that a mutual fund has many holdings, right? So, for example, if you were buying this company, right, or this mutual fund, Delaware Smith Cap Growth Institutional, which is up 45% for 2020. Let's see exactly what you get, right? Because we said there is a different company that the fund is investing into. So here it is, Delaware Smith Cap Growth Fund Institutional. The ticker symbol is DFDIX. It's trading on the NASDAQ. It's trading right now for about $49.51. The last updated September 11th. And if we went back over the last year, we see that it was trading at about $34.95. And now September 20th is about $49.51. So it's up a good amount, right? So you say about 50%. But it's a 52-week range, $25 to $54. So it's about up 40% year to date. Over the last 5 years, up about 156%. Total net assets, total assets under management, total amount of money involved or that's in this fund, $1.8 billion. Here again, the expense ratio, 0.85%, right? Turnover is where some companies are being taken out, some are being added. And this is because the fund manager is making decisions. This is not doing well, let's take it out. This is doing well, let's add to the position, or so on. Turnover, okay? These are fees and expenses. Where it says front load, this one it says is not applicable. But there's some mutual funds out there that have what they call a front load. Which front load is basically a fee that you pay just to own the fund, right? So it could be a front load fee of 5%. So 5% of whatever you're invested would be a fee. This one in this particular company, this particular mutual fund doesn't have it, but someone have it, a front load, or sometimes they have what they call a back end um, load, which basically means that you would pay a fee when you're selling the mutual fund. The front end, you'd pay the fee when you're buying it. In this particular instance, this mutual fund doesn't have it. Let's go down. We already went over the turnover. Let's go down to any more fees. That's good. Now, the next thing I want to point to is the holdings, top 10 holdings. And remember I said when you buy a mutual fund, you get a little piece of all the companies the mutual fund is then invested in. So here are the top 10 holdings. Yeti Holdings, I don't know anything about it. I've never heard of that company, but it's about 4.68% of the total holding of this mutual fund. Boston Beer, ticker symbol Sam Adams, so we know it's an alcohol company, almost 4.5%. Exact Science, LGI Homes, probably a home builder, but so on. You see all these different holdings, and we can hit view more holdings. And here we'll see all the different holdings, right? Chipotle, Mexican grill, right? So we know that when you buy one share of this mutual fund, you're getting a portion or a piece of all of the different companies without you individually have to go and buy one share of Chipotle, one share of Simply Good, one share of Everbridge, one share of this and one share of that, because it would be pretty expensive to do that, okay? You buy one share of this mutual fund, and it is $49. You get a piece of all these. For example, I know, for example, that Chipotle by itself, this company is already, I think, probably over $1,000 for this one share. But this is how you're able to be diversified. Okay, it gives you sector allocation, right? So consumer services about 10%, industrial about 12%, healthcare about 27%, consumer goods 18%. So you are diversified, and it is a stock mutual fund, so 100% in stocks. Okay, so let's go back, and we said that the fees is one of the big downside of actively traded mutual fund. Came across this article in NerdWallet. Topic with how a 1% fee could cost millennials $590,000 in retirement savings. How a 1% fee could cost millennials $590,000 in retirement savings. What do you see these expense ratios? These numbers are small. You know, we just came across one. 0.85%. What's the big deal? That's nothing. But the same way compound interest over time makes your money grow, right? Because you have 40 years and you're investing and it's compounding and it is growing exponentially over time. that a small amount of money is growing over time. In the same way, these little fees, even though they seem very little, they have a big impact on your bottom line. Let me explain. So we said expense ratio of 0.85%, the example used on the mutual fund. For 0.85%, you pay $8.50 for every $1,000 you invested. Initially, right, if you only have $1,000 invested, you only paid $8.50. Most of the money, $991, is being invested. But what happens when you have $1,000,000, right? It's $8.50 per $1,000, right? So when you have $1,000,000 invested, it's going to be $8.50, and it's going to be $8,500. That's going to be taken out. So you see that $8,500. So you're getting hit two ways. You're getting hit by the little amount of by the money being taken out, $8.50 being taken out. You're like, that doesn't seem a lot. But the fact is, there is an opportunity cost. What do you mean? Well, that $8.50, if it was not taken out, would have been invested and would have been compounding over time. And you have lost that because it wasn't invested. It was taken out. Okay? All right? So essentially, it's less efficient, right? And that's one of the reasons why actively managed funds underperform the market, right? And the reason is the fees. Because even if everything is the same and they perform the same return, the fees is going to be a drag. Let's look at this. This is Vanguard Total Stock Market Index Fund, VTSAX, right? It is essentially, it's like buying the market, right? It says here, it's created in 1992. Vanguard Total Stock Market Index Fund is designed to provide investors with exposure to the entire U.S. equity market, including small, mid, and large cap growth and value stocks. Okay? So it's domestic stocks, it's general, it's a large blend. Now look at this expense ratio. The expense ratio for VTSAX, which is an index fund, and you basically buy an entire market, is 0.04%. So this means that it is only charging you 40 cents for every $1,000 you have invested, compared to the one that we looked at before, with charging you $8.50 with the expense ratio of our 0.85%. So $8.50 compared to 40 cents, it is probably over 20 or 30 times. That's how index fund beats actively managed fund. Because over time, that drag that they're taking money and siphoning money off your account, you don't have that in index fund. More if your money is invested, more if your money is compounding. That's how you win with index fund, right? So they said the actively managed fund cannot beat the market. So one, you're getting a less return or more inferior return, and on top of it, you're paying a premium for it. So you're losing in two ways. Okay? So mutual funds are a great way for you to be in the market, great way to be diversified without spending so much money. But the actively managed funds are a terrible way to go. Let me just add this and then we can come to a close. Before I started really getting into finances and started reading and studying, I was in actively managed fund. I did not know. When I went online and looked at the ticker symbol and said, wow, what is an expense ratio? I didn't know that the expense ratio is what you're paying, and you're paying for not getting good results, and it's costing you, right? So we see here the article we looked at said how it could cost these people over over 500,000, almost $600,000. So imagine if this person would have ended up with whatever they were supposed to end up with. They're going to end up with $590,000 less. Okay, let's look at this couple of things, and then we're going to stop. It says, as illustrated, I like this quote, as illustrated, 1% versus 0.5% may not feel like much over the course of a year. But when saving for retirement, it could mean the difference between retiring at age 70 versus retiring at age 73. That means that because of the drag and the amount of expenses you're paying and the poor performance, right, and eating into your return, it may mean that you have to work 3 years longer just to get to the point where you need to get to. Let's look at, I think, one graph, and then we will come to an end. So let's look at this. Number of years invested. So you invested for 10 years, right? And this is assuming you're invested in a actively managed mutual fund. After 10 years, and you're paying, say, 1%, the portfolio value lost to fees will be by $11,343. After 10 years, in an actively managed mutual fund paying by 1%, you lose about $11,343 due to fees. It's that the after fee investment value, so after 10 years, you're going to end up with about $166,000, which is good, but it says the value lost to fees is 6.4%. If the fees wasn't that high, your money would be 6.4% higher. You lost 6.4%. After 20 years of investing, the portfolio value lost to fees is $61,696 lost to fees. You see, when time goes by, you're losing more to fees. After 20 years, your after fee investment value, your account is worth $435,000, which is good. But the value lost to fees is 12.4%. You have $435,000, but you would have had 12.4% higher if the fees wasn't dragging on your portfolio. After 30 years, the portfolio loss to fees is over $210,000. The after fee investment value is $914,215, which is a nice portfolio for 30 years. But you see, it's 18.7% lower than it would have been. After 40 years, and this is what the article was getting to, after 40 years, the portfolio value lost to fees is $592,790 lost to fees, over $500,000 over 40 years lost to fees. Your after fee investment value, your portfolio is worth $1.77 million, but it's 25% lower than it would have been. That's terrible, okay? That's terrible. You're paying a price, and the performance simply is not there. Warren Buffett said in his will, what he's leaving his wife, is that 90% of the money is going to be invested in a broadly based index fund, which is basically passive investing. He doesn't believe in the actively managed stuff. 90% of the money is going to be in actively managed, 90% is going to be in an index fund. That's how much he believes that's the way to go. So guys, that's another video to increase our financial IQ, all right, and open up our mind and understanding so we can take advantage and to take responsibility for our personal finance by educating ourselves and educating our children so we can break the cycle of generational poverty. We have to learn from the past. Can't do anything about it. We have to plant seeds in the present. And then we have to, and the reason why we're planting seeds in the present is so we can have an exceedingly and abundant harvest from all our hard work, right? From all our hard work. And we can reap the fruits of our labor. I want you to let people know, send them a link if they think they can benefit from this, and command your money to grow. And I will see you on the next one.